the snapback in the economy in the US, do you expect it to be just as fast as what we saw in the middle part of last year into the summer?
Well, we do think that it's going to be a really sharp recovery. We think there's a lot of pent-up demand. Obviously, there's some uncertainty around the timing with the vaccine rollout and such, but we're bullish on not just the U.S. economy, but also the global economy, and have been leaning into that in our portfolios.
Walk me through how that shapes your view around duration in the portfolio at the moment, Michael.
Yeah, we're pretty cautious on the path for interest rates. We think the risks are tilted in favor of higher rates, not lower rates. And so we're actually running all-time lows in duration in our portfolios right now. So, I think one of the things that hasn't been talked a lot about so far is there's been a lot of discussion about the equity rotations into value and cyclicality. But in the fixed income market, what we're seeing is because rates are really, really low and moving higher, it's a pretty difficult backdrop for investors that are sitting in treasuries or investment grade bonds where there's a lot of interest rate risk and not much yield. And then when you factor in expected inflation, you're dealing with profoundly and deeply negative real yield. It's a real tough situation for income oriented investors.